Well, I'm here with Jim Strang. He is the Managing Director of the Investment Committee for Europe at Hamilton Lane. Jim, thanks for joining us here at the Deal UK Economy event.
Pleasure.
I want to talk a little bit about the kinds of deals that you are seeing specifically in and around this time. What kinds of transactions are taking place, and probably more importantly, what are the trends that we're going to see in the months ahead?
In the UK in particular?
Indeed in Europe.
Yeah, well, I think what you've seen in the UK is that the deal market slowed. With the uncertainty of the last 6-9 months, clearly, it's put a bit of a premium on investors to be just very committed to what they're buying. The level of uncertainty has clearly risen, and it's difficult to find conviction. So you multiply the level of uncertainty by the sort of prevailing market conditions, which are pretty high pricing levels, pretty liquid credit markets. That's a difficult combination of factors, and so you've seen investors be cautious and really just focus and make investments where they've got really high conviction that whatever the prevailing uncertainty might be, they're going to see the other side of that and still make a profit at the end of the day.
See, that's interesting because the conventional wisdom is that UK companies are so significantly cheaper now than they were prior to the Brexit vote, that it's attracting a lot of foreign capital irrespective of the indecision. But what you're saying is that is still a factor that people have to take quite seriously.
Yeah, well, I think foreign capital, clearly, if you're a dollar investor, the UK's become a bit of a bonanza. And sadly, if you're like me and just been to America for holiday, it's the other way around. But for most private equity firms, for example, I mean, they're investing in a base currency of euros, not dollars.
Right.
So they've not seen the same bargain basement situation as created by dollar strength versus to the euro. So that's been the factor. So the currency arb around, gosh, it's a cheap time to buy assets. That is true if you're in dollars, but not so much if you're in pounds or in euros. And most of the European private equity industry is in pounds or euros.
See, that takes you right back to then the central core of the value proposition. What kind of economic platform is going to exist in the UK after the negotiations begin, firstly, but once the negotiations are complete?
Yep.
Is that defining the way that you're speaking to potential investors?
Well, I think because we are a money manager, so we back the people who make the investment decisions, and so our decision is an allocation choice, which is who do we want to back in this environment? How do we want to lay our chips on the table? But insofar as we're talking to people that are dealing in Europe and in the UK in particular, what we're seeing is really what I mentioned earlier, which is they're being very cautious and they're focusing on where they've got the most degrees of conviction around. We know how to do this. We've done this before. We therefore feel very comfortable doing it despite whatever the prevailing uncertainties will be. And also they're clearly looking for investments where they try to minimize the exogenous risks. So say, for example, energy has got a significant exposure to an exogenous risk, which is the oil price.
Sure.
Where if you're buying something which is not a discretionary purchase, you have to have it come what may, then that gives you more comfort that despite what happens in the economy, it will vacillate one way or the other. People will keep drinking beer, for example. Yeah. So therefore, that seems like an asset that's got a different risk-return trade-off to something with a big exogenous risk factor.
Is single market access an exogenous risk that you would have to articulate?
Depends which lens you look through. So okay. I think for example, if you look at the UK businesses, you have if you look through the lens of scale, small businesses tend to be more domestically defined, and big businesses tend to be more internationally defined. So all things equal, there are more small companies that are just driven by UK-specific factors, and so they're not exposed to the friction costs of a disruption to the trade agreements, for example. So if you own a nursing home business in the UK, then it's all UK-driven. If you own a small manufacturing business in the UK, which is trading globally or internationally, then you are. So there's a bit of that comes into it, and typically as the businesses get bigger, they're more globally defined, and therefore they're more aware of the friction costs. And that is a level of uncertainty where I think you see that in the deal market. As people look for businesses which have got this exposure to something that's just unknown at the moment, then it has to be accounted for.
So that would speak to a great deal of selectivity, one would think, when it comes to asset selection.
Oh yeah, I think that you see that. I mean, and you're seeing more and more of the deal makers being just very conscious of fighting the battles that they know they can win, and also that they should win. So this focus on, this is one for us. We know what we're doing. We've done this before. We've got high conviction because the risks are higher. Yeah. It's almost like flying in an airliner. You fly at 60,000 feet. There's not a lot of air up there. Yeah. So if you have an upset, the outcome is not going to be great. Whereas if you're closer to the ground, it's a different story.
That's a good point, and I suppose it speaks to what indecision is going to be created by the triggering of Article 50, which we assume will happen in the coming days, between that trigger and the end of negotiations. Is that enough of an uncertainty to put deal activity to a halt, or can investors drive through that if they're putting forth the selective criteria that you articulated?
Investment's like a shark. You've got to keep swimming. You can't stop.
Yeah.
So I think what it does is it just forces people to be much more thoughtful about where they look. And I think what's going to happen. I mean, the triggering of Article 50, which has been to some extent delayed by the actions of the Scottish government and asking for a second referendum, but assuming it happens the next week or two, it's really the phony war. Because all that will happen then is we will go through this process of a couple of years of trying to figure out what a negotiated outcome looks like, and odds on we'll not get there because the complexity is so enormous. So I think most people are not underwriting to it's 2 years from the 1st of April and then we'll all be done and done. Nothing further from the truth, I would have assumed, certainly by historical precedent. So it's more, we're going to deal with a period of uncertainty for a long period of time. And what I think investors are doing is just trying to figure out where the interest groups lie. So, to your point around trade agreements, that will be a high priority, so that the UK government will, I hope, be understanding where the most powerful trade agreements or most significant risks in trading actually are, and putting those up to the top of the queue in terms of which to go after first. And then we'll see what we get to. But you just don't know what the outcome is going to be, and that's the challenge.
That's a good point, and it brings you to the question about talent, because if we're looking at business growth, we're looking at two concepts, or maybe two poles, where we have innovation and talent, retention, attraction.
Yep.
If, as we understand, the government is prepared to prioritize immigration control over single market access, for instance, is that a significant enough concern in terms of business growth or blunting business growth for investors to be concerned about? That
we lose the talent, basically. Yeah, I don't know if that's front of mind right now. I think there's a general consensus that the talent piece will not be the biggest challenge. That there will be a breakout of common sense, and people will realise that it's actually quite a difficult thing to unpick, and therefore there will be an agreement around something close to the status quo. I don't think that's the challenge. The growth piece is the bigger challenge, which is, how do we create growth? How do we manage through growth in an environment where it's a really difficult environment? I mean, the irony of it is actually European growth has picked up a little bit, but from a relatively low base, and there's all this uncertainty out there about where it goes. So I think when you look at business plans for deals, you typically see more levers having to be pulled to create growth, it taking longer to come through. And then the biggest challenge of all is that what do we assume for the multiple that we can sell these businesses at the time that we sell them? Because it's unlikely to be above where we start from. And the question is it going to be the same or is it going to be below? And if it actually is below, then it doubles up the imperative around the growth piece. And that's why it ends up being a game about where do we really feel we can make money, because if we don't have the conviction, we'll not get the growth and we'll not make money.
Good point to leave it on. Thank you very much. Jim Strang is the head of the Investment Committee for Europe in Hamilton Lane.
Thank you.
Thanks, Jim.